Disclaimer.
The bell just rang at the New York Stock Exchange, and the silence you're hearing is the sound of a billion-dollar trap snapping shut. It is Friday evening, January 16th, 2026. For the last 48 hours, you've watched a miracle in the metal and a funeral in the stocks. While silver screamed past $91, hitting historic highs, the mining companies, the very ones pulling this precious metal out of the dirt, were held in a death grip, their share prices mysteriously frozen as if someone had pressed pause on reality itself. The closing tape tells you everything you need to know. The banks tried to pin silver under $90 to save their short positions. They failed. Silver closed at $91.37, and in that single moment, billions of dollars changed hands in ways that Wall Street's biggest players desperately tried to prevent. This isn't just a price move, and if you weren't watching the silver market in those final minutes of trading, you missed one of the most significant financial events of the decade. Millions of call options just expired in the money. The banks are now legally obligated to deliver metal they don't have and buy back shares they've already shorted into oblivion. The option pin is gone. The beach ball has been released underwater, and it's rocketing toward the surface. The weekend you're about to live through, it's the last time you will ever see silver and its miners this cheap. Welcome to the Monday morning panic. Welcome to the end game. Let me take you back to 3:30 p.m. Friday, because understanding what happened in those final 30 minutes is critical to understanding the chaos that's about to unfold. Silver was trading comfortably above $92, mining stocks were climbing, and retail investors were celebrating what looked like a clean breakout week. Then, in the final 30 minutes of trading, something violent happened. Algorithms unleashed a coordinated selling wave that veteran traders are calling the flash short attack, dumping paper contracts into the market with one clear objective: push silver below that $91.37 mark before the closing bell. You have to understand what was at stake here. According to options data from the CME group, there were massive call option positions expiring Friday, with strike prices clustered right around that $91 to $92 zone. If silver closed above those strikes, the market makers who sold those calls would be forced to deliver physical metal or buy back their short positions at devastating losses. This is what traders call option pinning, and it's usually executed flawlessly by institutional players who control enough capital to manipulate prices during those critical final minutes. But here's where our story gets interesting, and here's where you need to pay very close attention. Despite selling pressure that briefly knocked silver down to $90.80, despite algorithmic waves that would normally crush retail momentum, despite every trick in the playbook being deployed in real time, silver clawed its way back. When that 4 o'clock bell rang, the price locked at 91.37, safely above the danger zone that institutions needed to defend. The pin failed. And when option pins fail in commodity markets, the consequences cascade in ways that most investors never see coming. Now, let me show you something that should make your hair stand on end, because it reveals just how artificial that Friday afternoon attack really was. There's an exchange-traded fund called SILJ that tracks junior silver mining companies, and for months, market analysts have been watching its ratio to the silver price with growing disbelief. On Friday afternoon, even as silver hit $91 per ounce, SILJ was trading at a ratio of 0.32 relative to historical norms. What does that mean in plain English? It means the stocks of companies that dig silver out of the ground were priced as if silver was trading at $60 per ounce, not $90. Think about that scenario for a moment. Imagine you own a lemonade stand, and lemons suddenly triple in price, but your lemonade stand's value stays exactly the same. That's not market efficiency. That's not rational pricing. That's artificial suppression, and it only exists when someone with enormous capital is actively selling to keep a lid on prices. Federal Reserve data on futures positioning shows exactly who that someone is. Large institutional players have been building record short positions in silver futures throughout this entire rally, betting against the very metal that industrial demand is screaming for. These aren't speculative positions. These are hedges connected to options they sold, derivatives they packaged, and promises they made assuming they could always control the closing price when it mattered most. Friday afternoon, for the first time in this cycle, they lost that control. And the moment the market closed, something remarkable happened to that SILJ ratio. In after-hours trading, with the artificial selling pressure lifted, junior silver miners started catching up to reality. The ratio began compressing, not because silver fell, but because the stocks finally started reflecting what $91 silver actually means for producer profit margins. This brings us to the delivery crisis that Wall Street is frantically trying to manage this weekend. And this is where your understanding of market mechanics becomes absolutely critical for what's coming Monday morning. When market makers sell call options, they're supposed to hedge those positions by owning the underlying asset, or at least having access to it. But in the silver market, which operates on leverage ratios that would make your mortgage broker blush, many of these positions were sold naked, meaning there's no physical metal backing them up. According to the Commodity Futures Trading Commission's latest Commitment of Traders report, commercial short positions in silver futures are at historically extreme levels. These aren't just paper contracts that can be cash settled with a handshake. Under COMEX rules, contract holders have the right to demand physical delivery, and with silver now firmly above $90, suddenly those delivery demands become very attractive compared to selling back into the market. Here's your weekend warning, and I need you to understand this with crystal clarity. Right now, at this very moment, market makers are looking at their books and calculating how many ounces they are contractually obligated to deliver Monday morning. Every call option that expired in the money Friday represents 100 ounces of silver that someone can demand. Multiply that across thousands of contracts, and you're talking about millions of ounces that need to be sourced from a market that's already running on fumes. The COMEX warehouses that back these contracts, according to the latest inventory data published Thursday, eligible silver available for delivery sits at roughly 270 million ounces. That sounds like a lot until you realize that industrial demand alone consumes over 1 billion ounces annually, and that China, which we'll discuss in detail shortly, has been vacuuming up available supply at premiums that didn't exist 6 months ago. What happened Friday afternoon wasn't just a failed attempt to pin options. It was the moment when the mathematical impossibility of the current paper silver market collided with the physical reality of constrained supply. Someone has to deliver those ounces Monday morning. Someone has to buy physical metal in a market where every dealer, every mint, and every major bullion bank is already struggling to source inventory. And here's the part that should terrify institutional shorts and excite everyone else. Unlike stocks, where you can always print more shares or settle in cash, physical commodities have a finality to them. When the silver isn't there, it isn't there. You can't algorithm your way out of an empty vault. You can't flash crash physical bars into existence. You have to go into the market and buy at whatever price clears, regardless of what that does to your quarterly bonus or your fund's performance metrics. This is what market professionals call a squeeze, but that term doesn't capture the full picture of what we're witnessing. A squeeze implies temporary pressure that eventually releases. What's developing in silver looks more like a structural shift, where decades of paper market manipulation are finally hitting the hard wall of physical scarcity. The gamma trap that sprung Friday afternoon isn't just about 1 week's options expiration. It's about the entire architecture of price suppression cracking under its own contradictions. Monday morning, when markets reopen, we're going to see institutional buyers who spent months selling silver suddenly scrambling to buy it back. We're going to see mining stocks like SILJ that should never have been priced at 0.32 ratios, finally closing that gap in violent upward moves. And we're going to see retail investors who understood this setup and positioned accordingly rewarded for recognizing what the smart money desperately tried to hide. The question you need to ask yourself this weekend isn't whether silver can hold $91. The question is whether you understand what happens when the players with the deepest pockets and the most sophisticated algorithms lose control of a market they've manipulated for years, and whether you're positioned for the Monday morning panic that comes when they realize the gamma trap they walked into has no easy exit. If you're still watching, thank you for staying with me through what I know sounds like an impossible scenario, but I promise you, the evidence we're about to examine will make Friday's closing price look like the calm before the storm. Before we dive deeper, if this analysis is opening your eyes to what's really happening in our financial markets, hit that subscribe button and leave a like. Because what I am about to show you about producer margins and Asian premiums is information that Wall Street absolutely does not want reaching Main Street. Now, let me prove to you with simple mathematics why the current mining stock prices represent the opportunity of a generation, and why that gap must close violently in the coming sessions. Take Hecla Mining, ticker symbol HL, one of America's oldest and most established silver producers. According to their most recent quarterly earnings report filed with the Securities and Exchange Commission, Hecla's all-in sustaining costs for silver production run approximately $26 per ounce when you factor in mining, processing, refining, and administrative overhead. With silver closing Friday at $91.37, do the math with me. 91 minus 26 equals $65 net margin per ounce. $65 of pure profit on every single ounce they pull from the ground. To put that in perspective, that you can imagine running a coffee shop where your costs are $2 per cup, but you're selling each cup for $9. That's not a business, that's a money printing operation. And yet Hecla's stock price as of Friday's close sits nearly 15% below where it traded in early 2025 when silver was hovering around $70 per ounce. Think about that impossibility for just a moment. The company is now making $65 per ounce instead of the $44 per ounce they were making at $70 silver. Yet their equity value has actually decreased. According to basic financial theory taught in every business school in America, a company's stock price should reflect the present value of future cash flows. When those cash flows jump by nearly 50%, the stock should respond proportionally. But it hasn't, and here's exactly why. The same institutional players who sold those call options we discussed in Part 1 have been simultaneously shorting mining stocks to hedge their positions and suppress any excitement that might draw retail investors into the sector. Data from Fintel's short interest tracking shows that SILJ, the junior silver miner ETF we mentioned earlier, carries short interest representing over 18% of its float. Someone has borrowed and sold nearly 1/5 of all available shares, betting that the price will fall. This creates what market technicians call a coiled spring scenario. Every dollar that silver rises increases producer margins exponentially because their costs stay relatively fixed while revenue per ounce climbs. Eventually, even the most aggressive short seller cannot ignore $65 margins turning into $75 margins, and when they start covering their positions by buying back those shares, the upward pressure feeds on itself. According to research from JP Morgan's Commodities Desk, a 10% move in silver prices historically translates to a 30 to 40% move in producer equities due to leverage dynamics. We're not talking about a 10% move anymore. We're talking about silver that's rallied from the mid-60s to over $90 in less than 6 months and mining stocks that have barely moved. That gap represents billions in market capitalization that hasn't been created yet but must be, because mathematics don't care about algorithmic suppression or institutional short positions. $65 margins are $65 margins, and when quarterly earnings start printing these numbers in black and white, fund managers who've ignored the sector won't have a choice but to chase. Now let me show you the Shanghai signal, because what's happening in Asian physical markets right now is the smoking gun that proves Western paper manipulation is hitting its endgame. The Shanghai Gold Exchange, which handles the world's largest physical precious metals trading volume, publishes daily price data that reveals something extraordinary. As of Friday morning Asian trading hours, physical silver in Shanghai was trading at a premium of $15 per ounce above COMEX spot prices. Let me explain why that premium is so significant and so alarming for our story. Under normal market conditions, silver prices across global exchanges stay within a few cents of each other through arbitrage. If London silver trades cheaper than New York silver, professional traders buy in London, ship to New York, and sell for the difference minus shipping costs. This keeps prices aligned worldwide within very tight bands, typically under 1%. A $15 premium represents a 16% price difference, and it's been growing wider throughout this entire rally. According to data from the Shanghai Futures Exchange, Chinese buyers are paying this enormous premium for one simple reason. Physical metal is unavailable at COMEX prices. The paper contracts trading in New York say silver is worth $91, but actual refined bars that you can touch and ship are commanding $106 in the world's largest physical market. This tells you everything about the supply crisis we're facing. China isn't paying $15 extra per ounce because they enjoy overpaying. They're paying it because their industrial base consumes more silver than any nation on Earth. And the alternative to paying the premium is shutting down production lines in solar panel factories, electronics manufacturing, and electric vehicle production. The World Silver Institute estimates that Chinese industrial demand alone accounts for nearly 30% of global consumption. And that demand curve is vertical because there are no substitutes for silver in most high-tech applications. Where is China getting this physical silver if COMEX prices are so much lower? They're draining Western vaults, specifically the warehouses backing those COMEX contracts we've been discussing. According to the CME Group's weekly warehouse stock reports, eligible silver inventories have declined by 42 million ounces since the start of this year alone. That metal isn't disappearing into thin air. It's being loaded onto container ships and sent east to buyers willing to pay the real price, while Western markets pretend that paper contracts represent actual deliverable metal. Here's the trap, closing from another angle. Every ounce that leaves COMEX warehouses for Shanghai is one less ounce available for the options delivery obligations created Friday afternoon. The banks that sold those call options assumed they could always source metal if needed, but they're discovering that assumption only works when physical premiums stay reasonable. At $15 premiums, even if they wanted to buy metal in Asia and ship it back to satisfy delivery demands, they'd be locking in catastrophic losses on contracts they sold at $90 to $91 strikes. This brings us to the technical analysis that confirms everything we've discussed is happening in real time on the charts. If you look at silver's daily price chart for this past week, Friday's candle tells a story that professional traders recognize immediately. We saw what's called a hammer formation, where the price sold off violently during the session, creating a long lower wick, but then recovered to close near the session highs. That hammer candle appeared at the exact moment that the relative strength index, a momentum indicator followed by traders worldwide, hit oversold territory below 30. According to technical analysis principles published by the CMT Association, when you get hammer candles at oversold RSI levels, it signals seller exhaustion. Every market participant who wanted to sell has already sold, and the vacuum of selling pressure creates conditions for explosive upside moves. The timing of this technical setup isn't coincidental. It happened on options expiration Friday, exactly when institutional players were throwing everything they had at pinning the price lower. They created the hammer candle through their own desperate selling, and in doing so, they've painted the technical picture that algorithms and trading systems worldwide will recognize when markets reopen Monday. Those systems don't care about manipulation narratives or conspiracy theories. They see oversold conditions, hammer candles, and they generate buy signals. What you're witnessing is the rare convergence of fundamental mathematics showing $65 producer margins, physical market premiums proving supply exhaustion, and technical indicators confirming that selling pressure has reached its maximum extreme, all at the exact same moment. When these three factors align, market professionals call it a triple confirmation. And it's the highest conviction setup that technical and fundamental analysis can provide. The numbers don't lie, and they don't negotiate. Silver closed Friday at $91.37 with producers printing $65 margins, and Shanghai paying $15 premiums for physical metal that COMEX pretends exists at paper prices. Something has to give, and based on everything we've examined, what's about to give is the artificial price structure that's held mining stocks in that death grip while the underlying commodity soared. Monday morning is going to force a reckoning between paper prices and physical reality, and I'm about to show you exactly what that reckoning looks like in dollar terms. Right now, as you're watching this video, something is happening in the physical silver market that you won't see reflected in any price chart until Monday morning, but by then it will be too late to position yourself ahead of the wave. Within the next 24 hours, I'm predicting that major online bullion dealers across America will start showing out of stock. Notices on their websites, and I'm going to explain exactly why this Saturday night sellout is already in motion. Think about the timeline from a retail investor's perspective. It's Friday night, markets are closed, and if you've been following silver's explosive move or you've stumbled across analysis explaining what just happened with options expiration, you're sitting at your computer making a decision. Do you wait until Monday to buy through the futures market or mining stock ETFs? Or do you lock in physical metal right now at current prices before the weekend gap creates a new reality? According to SD Bullion's public inventory data, which they update in real time on their website, their available silver inventory as of Friday afternoon stood at roughly 800,000 ounces across various products. APMEX, one of America's largest dealers, showed similar levels. JM Bullion's stock indicators suggested comparable availability. These numbers sound substantial until you realize that a single motivated hedge fund could clear out all three dealers with a phone call and a wire transfer, but it's not hedge funds making these weekend purchases. It's retail investors who understand what $65 producer margins mean, who've seen the Shanghai premiums, who watched that Friday afternoon flash short attack fail, and who have decided they want physical metal in their possession before Monday. This opening bell potentially creates a price gap they can't afford to chase. Based on typical weekend traffic patterns that bullion dealers have reported during previous silver surges, I expect we'll see a 3 to 5 times increase in order volume throughout Saturday. Here's why that matters for our Monday morning forecast. When bullion dealers sell out of inventory, they don't just shrug and wait for new supply. They immediately raise their premiums over spot price to ration remaining inventory and protect themselves from buying high to fulfill orders they sold low. During the last major silver shortage in 2020, premiums on American Silver Eagles jumped from $2 over spot to $14 over spot in a matter of weeks, and that was when silver itself was only trading around $28 per ounce. If we see dealer inventories exhausted by Saturday night, and if premiums start spiking Sunday as dealers adjust their websites for Monday morning, that creates a psychological effect on institutional money managers that cannot be overstated. These are professionals who've been ignoring silver because they assumed they could always buy physical or mining stocks whenever they decided the fundamentals justified a position. Suddenly, they're seeing headlines about bullion shortages, watching premiums explode, and realizing that the always available assumption just broke. That brings us to the SILJ forecast, and I need you to understand these numbers in the context of market mechanics, not hopeful speculation. We established earlier that CLJ was trading at a 0.32 ratio on Friday when it should have been pricing in $91 silver. If that ratio normalizes to historical averages, which typically range around 0.5 to 0.55 during strong silver markets, we're looking at a minimum 50 to 70% upside move just to reach fair value. But here's where the calculation gets explosive. That 50 to 70% move assumes normal market conditions, where prices adjust gradually through balanced buying and selling. What we're facing Monday morning isn't normal conditions. It's a situation where institutional shorts need to cover positions immediately, where retail FOMO from weekend dealer sellouts will hit at the opening bell, and where algorithmic trading systems will recognize the technical breakout and pile on momentum. According to analysis from market structure experts, when you combine forced short covering with momentum algorithm buying and retail FOMO, the initial gap-up move often overshoots fair value by 20 to 30% before pulling back. This isn't speculation, it's documented behavior from dozens of previous short squeezes across various markets. The Volkswagen squeeze in 2008, the GameStop squeeze in 2021, countless commodity squeezes throughout history all followed the same pattern. Gap up violently, overshoot, consolidate, then either crash back or establish a new higher trading range depending on fundamentals. In SILJ's case, the fundamentals support higher prices because producer margins are real, not speculative. So my forecast for Monday morning is a gap up open in the 15 to 20% range, potentially higher if weekend developments create more urgency than I'm currently modeling. That's not the ultimate upside target. That's just the Monday morning panic move as shorts scramble and late buyers chase. To put specific numbers on this for anyone tracking positions, if SILJ closed Friday at, let's say, around $12 per share, a 20% gap would open Monday around $14.40. Again, these aren't price targets for where SILJ should eventually trade, based on $91 silver. These are forecasts for the initial violent adjustment as paper prices try to catch up with physical reality and as short covering creates temporary supply-demand imbalances. Now let me give you the warning that I need you to hear clearly, because this is where the system could potentially protect itself in ways that hurt unprepared investors. The New York Stock Exchange and NASDAQ have circuit breaker rules designed to halt trading when individual securities or broader markets move too violently too quickly. For individual stocks, exchanges can pause trading if a security moves 10% or more within a 5-minute window. Here's the scenario that concerns me for Monday morning. If SILJ gaps up 20% at the open and then continues climbing as shorts cover desperately, we could see circuit breaker halts kick in repeatedly throughout the first hour of trading. Each halt lasts 5 to 10 minutes, supposedly to let markets cool down and allow for orderly price discovery. But what actually happens during these halts is that frustrated buyers place market orders that get queued up, and when trading resumes, those market orders execute at whatever price clears, often significantly higher than where the halt occurred. I want you to imagine trying to buy SILJ at $14.40, thinking you're getting in on a breakout, placing a market order during a trading halt, and then watching it fill at $16.20 when trading resumes because that's where the queued up buy orders finally found sellers. This isn't theoretical. This is exactly what happened to retail investors trying to chase GameStop during its squeeze. They got filled at prices that represented momentary panic peaks rather than sustainable levels. The same circuit breaker concerns apply to silver futures themselves if we see the kind of moves I'm forecasting. The COMEX has daily price limits designed to prevent runaway markets, and while those limits are fairly wide for precious metals, they can still be triggered during extreme volatility. If silver tries to gap from $91 to $105 on Sunday night futures trading, we could see limit-up halts that prevent further price discovery until Monday's regular session. This creates the nightmare scenario for institutions holding naked, short positions. They're obligated to deliver metal or cover shorts at market prices, but if the market hits limit up and stops trading, they can't execute their cover trades, even if they're willing to pay any price. They're trapped, and every hour that passes with silver locked at limit up increases their losses and their desperation to exit when trading finally resumes. Here's my final warning, and this is where everything we've discussed comes together into a singular message you need to understand. Once silver breaches the $100 psychological barrier, and I believe that breach could happen within the next week based on current momentum, the entire precious metals sector enters uncharted territory. We haven't seen triple-digit silver in modern markets, and the closest historical comparison is the Hunt Brothers squeeze in 1980, which ended badly for late buyers, but created generational wealth for those who positioned early. The circuit breakers, the trading halts, the potential for exchange intervention through margin requirement increases or forced liquidations, all of these systemic protections exist to prevent markets from moving too fast for institutions to manage risk. But those protections won't stop the fundamental reality that physical silver supply is constrained, that industrial demand is inelastic, and that decades of paper market manipulation have created a spring that's been compressed far beyond its natural state. When that spring releases fully, the price discovery process is going to be violent, chaotic, and incredibly dangerous for anyone trying to chase moves without understanding the mechanics at play. Your edge, right now, this weekend, is that you understand what happened Friday afternoon while most of the investing world is still asleep. You understand the Hecla math, the Shanghai premiums, the failed option pin, and the delivery obligations that must be settled Monday morning. The question is what you do with that edge. Do you wait for confirmation Monday morning and risk chasing gap ups and circuit breaker halts? Do you assume this analysis is overblown and that markets will somehow muddle through without the explosive moves I'm forecasting? Or do you recognize that we're at one of those rare moments in financial markets where understanding the mechanics ahead of the crowd creates asymmetric opportunity? I can't tell you what to do with your money. What I can tell you is that the weekend you're living through right now is the last time the silver market will look like this. By Monday morning, either my analysis will be proven wrong and we'll all learn something about market structure, or we'll be watching the beginning of a short squeeze that makes previous commodity. Squeezes look tame by comparison. Watch the bullion dealers tonight and tomorrow. If inventory numbers start dropping and premiums start spiking, you'll know the retail rush is happening exactly as forecasted. Watch for any news about COMEX warehouse inventories or emergency meetings over the weekend. Watch Asia's Sunday night futures, trading for the first indication of where Monday's gap might open. And whatever you do, understand that what happened Friday afternoon at 4 o'clock wasn't just another options expiration. It was the moment when mathematical impossibility collided with physical scarcity, when algorithmic manipulation failed against real-world supply constraints, and when the gamma trap that has been building for months finally snapped shut on institutions that believed paper markets could override physical reality forever. The Monday morning panic starts in less than 48 hours. The only question is whether you'll be watching it happen or positioned ahead of it. But here's what I haven't told you yet, and this is critical. What happens after Monday's opening chaos is actually more important than the gap up itself, because there's a secondary wave coming that almost no one is discussing, and it involves a specific catalyst that could send silver past $120 before February ends. I'm going to break down that catalyst in my next video, including the exact date it happens and why it represents the real endgame for paper silver markets. If you want to see that analysis before everyone else figures it out, make sure you're subscribed with notifications turned on, because I'm dropping that video within the next 72 hours. And the timing of that information could be the difference between getting positioned and getting left behind. This isn't just about Monday anymore. This is about what Monday sets in motion, and that's a story that's just beginning to unfold.